you co-founded Susa Ventures about 13 years ago. 13 years ago, still like seed funds weren't that common, and I would say it was still one of the earlier seed funds.
I was angel investing starting in 2010, and we were really fortunate to be one of the first investors in Robinhood and Flexport in that fund.
How's the ecosystem as seed and pre-seed changed over the last decade and a half?
There's now 900 plus seed funds out there in the ecosystem. A company that's running a competitive process, if they're talking to 20 funds, 19 of them are going to lose and one of them is going to win.
What's the thesis for your new fund? Is it problem specific? Is it industry specific?
The gates are down. And if you're a creative person or entrepreneurial person and you have an idea, you want to solve a problem, or you have an idea, it's easier ever to build a product. I think there's two types of entrepreneurs. I think there's an entrepreneur that wants to start a company, and there's an entrepreneur that wants to solve a problem. We tend to want to invest in entrepreneurs that are trying to solve a problem. You want somebody that is extremely persistent, that is going to run through walls to make things happen.
A lot of companies die not because they, run out of funding, but because founders lose optimism.
I think there's one reason why immigrants are such successful founders is they feel like they have to succeed.
Seth Berman, welcome to We the Builders.
Thank you for having me. Excited to be here.
Well, thank you for having me. We're in your house. No, this is my first time in Aspen. Gorgeous city. Thank you for all the recommendations, and it's great to have you doing your first video long form interview. I'm gonna take that badge.
No, I'm really enthusiastic to be here, and thanks for flying out to Colorado, my home state.
So you co-founded Susa Ventures about 13 years ago, which was, I would say, one of the 13 years ago was still like seed funds weren't that common, and I would say it was still one of the earlier seed funds in venture. Tell us a little bit more about your journey in venture, how it started, why did you start Susa?
Yeah. So I was angel investing starting in 2010, and I was fortunate enough to be one of the first people that would go to Y Combinator's demo days. And when I started going, it was probably 12 founders that were presenting and 12 investors in the audience. Today, I think there's like 250 companies that present and thousands of investors in the audience. So it was very, very different. I also didn't have that much money. So I was investing $5,000, $10,000, $25,000 into these businesses. And it was a totally different ecosystem at the time. I invested in 22 companies, and I think 6 of them sold relatively quickly to Google, Yahoo, BlackRock. And I was able to use that track record to start Susa Ventures. I remember going in, I was living in Los Angeles at the time. I went into a breakfast meeting with a friend of mine named Eva Ho, and I said, "Hey, would you like to start a seed fund?" And she probably thought about it for like 5 minutes and said, "Yeah, I'd love to." And we ended up starting Susa there. We brought on the original team. I was friends with Chad Byers and convinced him to come along for the ride. And Eva was friends with Leo Polovitz. And the 4 of us were really kind of the core team that started the fund. We were really fortunate to be one of the first investors in Robinhood and Flexport in that fund. It was a very small fund, $25 million.
Wow.
Yeah.
Must have been one of the best performing seed funds of that era.
It was, I don't know if it was the best performing seed fund, but it was definitely a really strong performance, and it had great TPI from Robinhood. But I think we invested in 5 or 6 companies that became unicorn businesses in a fairly small portfolio. So we were, thrilled with the success of that first fund.
And 6 exits and 22 angel investments, right? If over the last 5 years, I know a few angel investors, they would do 100 deals. The check sizes are way bigger, obviously. Now 25K is like probably become the minimum if you want to get any meaningful return. And I'm not confident they can go out and raise a fund with that track record. So in that sense as well, that they, because there's no exits, there's
Absolutely.
You know, there are way too many companies. You're not even after 100, I guess, investments you're not able to build the same type of a track record, and the ecosystem is completely shifted. So how's the ecosystem as seed and pre-seed changed over the last decade and a half?
Yeah, there's been enormous change since when I started back in 2010. It's now 2026. So, 16 years ago. When I started, there were multi-stage funds doing seed, but they're writing very small checks. So they're writing 25, 50K checks purely as options to see if they can invest in those companies or be able to track
almost
them
like
in the
scout
future.
checks. Yeah.
Almost like a scout check.
Yeah.
And what happened was the multi-stage funds felt like, okay, we're missing a lot of these deals that we wrote these smaller checks into, and we have the strongest brands in the ecosystem. We should just take our ownership up front. And it's much cheaper for us to take our ownership up front than it is to do it at a later stage. So if we're going to do a seed stage deal, we should try and own 10 to 20% of it and write like a $1 to $5 million check. And they didn't care as much about valuations as the seed funds did, because for them, if it was 10 million, 20 million, 30 million, 50 million, it didn't really matter because it's so much cheaper than it was at the later stages. And so all these multi-stage funds, I'd say starting in 2015, 2016, started writing meaningful seed checks. And then the other thing that happened is there was a maturity in the fund of funds where a bunch of fund of funds got spun up purely to invest in early stage seed stage funds, either first time managers or kind of more established seed managers. And so there became this mechanism and pool of capital to put people in business. And when more and more seed funds got put in business, there was more and more capital out there, and it became much easier for founders to raise a seed round. And I think when I first started, there were, companies that would start and they'd kind of do like a friends and family round first, or put in money themselves, and they'd stand up a product, build a small team, get some customers, and then they go to these seed investors. And there's a very small group of those seed investors, and they all collaborated with each other. The deals would get passed around between the 5 or 6 different seed funds at the time, and people would write 250 to 500K checks, and a round would come together. Then obviously those seed funds became much larger, and now they each have to own like 10, 20% of those businesses to get a strong return. And so it's very challenging for them to let other large seed funds in, or multi-stage funds. So it becomes a winner take all round, or it's these small, single GP funds that are collaborating with each other, and maybe 2 or 3 of them will come together and do a round. But it's much different from when I first started, when everybody would collaborate with each other. But because of these pools of capital that are now investing in these emerging managers, there's just been an absolute explosion of seed funds. There's now 900 plus seed funds out there in the ecosystem. And so you can imagine the number of companies that are being started every single year. And it's not just the seed funds. You also have every single multi-stage fund that is investing in seed today. And so one thing that I thought about is, what stage do I really want to be focused on going forward? And I felt like there's a tsunami of seed stage deals coming to Series A. And Series A funds, there's probably 30 super high quality funds, but there's not 900. And so I graduated from doing seed to Series A and B now. And so we have a Series A and B fund that we call Kivu that I manage. And now some of the people from the team are managing our Susa fund, but I'm more focused on companies that have some sort of product market fit, have a product in market, have customers that we can speak to, have a team that we can DD before we invest.
When you started doing your angel checks, what was the state of the company back then?
Yeah. So I think when I started doing angel checks back in 2010, it was just a totally different era where, typically we are investing in between a $2 to $8 million valuation. A $10 million valuation was just crazy. It was like, oh my God, this is nuts. And then 20 was just like in another galaxy. And typically we were writing very small checks. Everybody was able to get in. It wasn't like challenging to get into these deals. It was more of like, hey, if you'll give us money, we'll take it. And a lot of the best companies, went around, and sometimes people didn't make good decisions to invest in them. One of my biggest misses was Pinterest. I remember meeting with the founders outside at TechCrunch Disrupt. I think they didn't want to or didn't have the money to pay for like tickets for TechCrunch Disrupt. And so they said, hey, we'll meet you outside the venue. And for some reason, I just didn't get there on the investment at that time. And I couldn't sleep for like 6 weeks after it started like growing at such a rapid pace that, I felt like it was like, I was never going to get another opportunity to invest in one of those businesses. But fortunately I was, but, I think that at that time, just using Pinterest as an example, the metrics that they gave me where they had 20,000 people using their product daily. And a big metric that you look at the time was time on site. I mean, this was even before like mobile apps. This is when people were still using desktop, and looking at websites. And so the number that I remember seeing was there over 20 minutes time on site per day. And that was a similar number to what Facebook had. And so I should have known that with that much engagement, they were going to build something really special. And that was a big miss for me.
It's pretty incredible that, what Pinterest you were evaluating as an angel check, right? Back in the day, 16 years ago, had significant traction, right? Like, but today you wouldn't see a Pinterest at pre-seed. You would probably see it like at A or something.
Yeah,
late seed or A.
Yeah, I think that's a really good point. I think when these rounds come together, it's all about competition. If it's a high pedigreed founder that's coming out of a great company like Stripe, Robinhood, Google, Meta, etc., they don't need to have much to raise. And so they can literally just have an idea and pitch it and raise funding and not even a deck. So what's happening today is any founder that has really strong experience can go out and fundraise with no product. And it usually takes, I'd say, 1 to 3 years for them to build a team, build a product, and try and find customers. And during that time period, they might pivot 5 or 6 times to actually figure out a product that they want to build.
What's the thesis for your new fund? Is it problem specific? Is it industry specific? Or is it just agnostic, opportunity dependent?
Yeah, so we're focused on 2 different areas. One is vertical AI. And the other I'll spend some more time in because I think vertical AI, most people understand it fairly well today. But I'll just say one thing. I think kind of the first piece of really the internet was just digitizing the filing cabinet and, doing the basics to bring things online. And I think that what we're seeing in AI, and everybody talks about this super cycle and how it's changing everybody's workflow on a daily basis, is I think a lot of these models, whether they're vertical specific or they're horizontal, is they're breaking the benchmarks way faster than anybody could imagine. And I see adoption of them at much higher rates than I've seen, other super cycles in the past. And I think you can look at like any of the usage of these models and see that the growth is just like absolutely insane. But I'm sure you've had a lot of people talk about, AI over the last few podcasts. So I'll talk about something that we're focused on that a lot of other funds are not focused on. And we call it physical intelligence. And so if you think of like Web 1.0 or AI 1.0, we think AI 2.0 is really when intelligence starts affecting physical objects. And I think the best example of this, obviously, is your Tesla car and FSD driving. But, you know, even having your Meta glasses, or soon like your Warby Parker, like Google glasses that are coming out, having AI on your person and be able to check, affect your life is going to be, something that is going to be really powerful. And if you walk outside today, your life really isn't that much different than it was 30 or 40 years ago. Yeah. But our feeling is that is about to change, and that there's going to be so many different things that are going to happen over the next 5 to 10 years that bring intelligence into every person's life on a daily basis, and on the manufacturing floor, in agriculture, and in construction. And so we're trying to find kind of the picks and shovels that invest in those models and in those businesses to allow, this new ecosystem to be built.
Well, it's funny that I didn't come up in our breakfast, but let me give you a little background on how this started. Fall of 2022, most of the companies I was running into were either doing SaaS or crypto, and I just couldn't make sense of 99% of them. And I was like, maybe I'm just not built for this game. And I ended up finding this humanoid robotics company called Figure AI, and ended up writing an angel check, very small. My regret is I should have had more money to write in that, maybe. And irrespective of how humanoid robotics play out, right? Like at the time, it was very unpopular. At the time, intelligence in the physical world was, you would imagine it's not, but fall 2022, everyone was laser focused on crypto up until the Sam Bankman-Fried saga happened. And so since then, I've been thinking about this, that, so that's my follow-up question is, do we have the talent pipeline for that, this new generation of companies?
Yeah, I think from the people that I speak to, this is the most exciting field. And so all the people that were working in fintech or cloud infrastructure or all these different businesses are now really excited and interested to work in physical intelligence. And I think Figure AI is a great company. Actually, one of my partners in this fund is Emery Wells, and he was an early investor in Figure.ai and likes to reference them on a regular basis.
Oh, cool. Okay.
And I think, the robots are actually like incredible. So I think that there's going to be a lot of talent that's going to funnel into these industries, but I do think it's a different type of talent. And hardware talent is very different than software engineers. Yeah. And so I think a lot of them will come out of larger businesses that have, hardware components that they're building today. And some of those people tend not to be as entrepreneurial, but as more and more of these companies get funded and they feel like there's real value in those businesses, it'll be easier to pull those people out.
Or maybe perhaps, if this, I think this era of excitement around the physical world or building companies in the physical world is not that old. It's probably, maybe we're into year 3 now, right? And perhaps this is the right timing because we're in the second innings, and maybe, some talent from the companies that were funded, whatever dollar amount went into funding these companies is going to start producing, in the next 2-3 years, a generation of talent that can go on to either build new companies or go work for the best companies of their era. Is that right? Like, do you relate that? Can you relate to the second innings of any of these eras being? better for
Yeah,
investing?
I think what you're trying to say is, you look at the PayPal mafia and all the different businesses that they were able to start. And now you look at SpaceX and the enormous amount of talent that has come out of SpaceX to really like build incredible businesses in the aerospace industry. And you see this, like, if you walk around El Segundo, just outside of Los Angeles, literally on every other block, there's like, a startup from a SpaceX, like ex-employee. And so what are going to be the companies that are kind of going to spur this next like physical intelligence boom? Are they coming out of Tesla? Are they coming out of SpaceX? Are they coming out of like larger robotics companies or Apple? I don't know if there's necessarily one company that they're coming out of yet, but I think we'll probably find some, some companies that are developing a lot of talent over the next like few years. And it might be a startup that's developing this talent themselves. It could be Figure AI, or it could be out of Tesla and their Optimus project.
When you had this thesis, American dynamism wasn't probably a thing. You started the fund about 2-3 years ago, I'm guessing, right?
Yeah, we started this thesis more recently, but yeah.
So have you seen, I know like we're probably largely since the ChatGPT moment have been in this AI super cycle. We actually don't talk about this a lot on the podcast, or we can dive a little bit deeper into it. But there were these I think there was a mini defense boom, and then it has been around, and then there, at least on Twitter, this became like a mini cultural movement. El Segundo, all the founders there really started hyping up deep tech or building in the physical world. They're not all deep tech companies, and in the same way, I think some funds started hiring defense partners. It was a whole like era that we saw, right? This sort of I would say behavior, like what kind of like builders does that attract? And what I've observed in my very short time is that whenever there's a super cycle, there's a lot of noise that fills up the market, and you have all sorts of founders flowing to the market, and which is, I guess, what makes seed and pre-seed so hard to do. So what have you observed about?
Well, I think there's two types of entrepreneurs. I think there's an entrepreneur that wants to start a company, and there's an entrepreneur that wants to solve a problem. And we tend to want to invest in entrepreneurs that are trying to solve a problem. And so what we've seen is that there's people that work at some of those companies like a SpaceX or, what have you, that feel like there's things that need to be solved. And they start working on those problems to solve them. And that's a very different journey than somebody that's trying to figure out a product and make it work.
I think that's like a really good framing, that you have to look to solve a problem, and a company is
experience that problem before, have some domain expertise to understand, why the problem exists and how to solve it.
The other thing we were discussing over breakfast was that now it's even probably more possible than ever with for people who don't necessarily have the technical expertise or the background with the tools available to build companies. We were talking about creatives specifically, but that's the other side of the conversation, where on one end, maybe people with domain expertise are supercharged, right? And are probably the right fit to build to go after certain type of problems. But then we're in an era where like a creative can come in with no technical expertise really and build a sizable business. Can you say more about that thesis? What is that thesis?
I think the gates are down. And if you're a creative person or entrepreneurial person and you have an idea, you want to solve a problem, or you have an idea, it's easier ever to build a product. Whether it's building an app with a product like Replit or Lovable, or using Cloud Code or Cursor and not really knowing how to code. You could have been a product manager, at a business and saw like a problem that existed. And then in the past, you'd have to hire an engineering team to build a product. You can now trial out products and see if they solve a problem for you. Even internally, if you're working at one of these businesses, if you want to be a creative and come up with different imagery for a deck or create a deck or, do a motion picture or a TV show, you can use AI now to do that. We actually invested in a company called Promise that does end-to-end AI, TV, and film. And so the idea is that you don't need actors, you don't need cinematographers, you don't need any of the grips, the lighting, et cetera, that everything can be purely done through AI end to end. And I think this democratization of all of these different industries is going to allow people that have great ideas, but don't necessarily have the skill set to build them, to go out and build some of these businesses. And I think a number of them will be very successful.
Are we going to go back to an era of high founder ownership, sort of businesses that become really huge?
Yeah, well, I think like there's been a lot of talk about like the single founder, single employee building like $1 billion business.
Yeah.
I think it's definitely possible. I think it will be extremely challenging. I think you're going to still need a team of people because
I think right now we're in the prototyping era.
Yeah,
I don't know how useful the any app or website you build through Replit or Lovable actually is.
Yeah, I totally agree with you. Yeah. We're definitely in the prototyping era.
But you could see this like maybe as technologies can, iteratively continue to improve. We're maybe in the Web 1.2 era if you were to compare, and 5 years down the line, 7 years down the line, you have just completely different capabilities.
I totally agree with you.
Oh, interesting. So, okay, that's interesting. Do you think by that same account, I guess, is it the end of credentialism? Is it that like, for example, if like 20, 25 years ago, you were fixated on finding a PhD biologist to go after a very specific problem that has the background in doing it, that let's say was working on brain-computer interfaces and testing throughout their PhD, and that was their thesis, and they go on to go work at these companies. But now you have a mathematician who for some reason gets interested in working on brain-computer interfaces, and they have more tools available to them to go do it. Do you think we're also in that era now?
I think we're close to it. I think if you look at benchmarking with these LLMs of where they're at today, I think they're going to hit prime human sometime in the next 2 to 5 years. Prime human being Albert Einstein level intellect. And once people have access to those models and can basically do any research or ask any sort of questions that they want to ask, I do agree that it's going to open up the floodgates. I still think you need to be creative and you need to be able to run in a certain direction. It's like being in the middle of the desert and not knowing which way to run to water.
Yeah.
So you still need to have some sort of direction of where you want to go. But yes, if you had an idea of, I want to build like, a human to brain, a computer to brain interface, like a Neuralink or science, it's going to be a lot easier to kind of put together the framework. The testing will still be extremely challenging as you'll probably need a test in primates, do clinical studies, and that could cost hundreds of millions of dollars to do. But, it's going to be a lot easier to do the initial research to see if it's possible.
The way I was thinking about this was that if whatever encyclopedia was to the researchers of the time, right? And then it like evolved into Google, and you went from, or I guess like if you go even further back, libraries became, encyclopedia, and you went down from days to hours, and or like from weeks to days, and then you went down to hours with Google, right? And then we're now in a completely different era of like probably going into the depths of a specific problem, and the number of problems you can, I guess, get to the bottom of and in a given amount of time. So the range, I guess I'm looking at this as like one person getting incredible amounts of range, orders of magnitude more range than they could have gotten with tools before.
Yeah. So I think there's a lot of things out there that allow you to do a huge amount of research very, very fast. Things that would take a month or a year to do, you can now do in literally minutes. And so some examples of that are, there's all these expert networks out there today. Tegus, Alpha Sites, Office Hours, GLG, Intro. And there's now AI that lives on top of these expert networks. One of the companies is called AlphaSense. And you
record calls, right?
Tegus records the calls, and they create transcripts of the calls, and then these AI like live on top of them. And so you can basically get a bunch of expert commentary within minutes if there's transcripts available with those people on specific topic areas. And then you can kind of plug that into your LLM if you're using Gemini or ChatGPT, what have you, Anthropic, and then do deep research with those experts' opinions and come out with like a market mapping, ideas, all sorts of research within an hour or two.
Oh yeah.
Which would take, to set up all those expert calls and then go through those notes and do that analysis would take months in the past.
Oh yeah. So where does that put us in this AI for science era?
Yeah.
Right. Because within the last, I guess, 6 months, there's been more movement around that. A lot of companies have come out of stealth. A lot of companies have announced a lot of funding. Some are in the material science discovery space. Some efforts are in the super labs. How are you looking at that?
Yeah, so I think that if you look at any space, let's just say like oncology, and you have cancer researchers, and there's so many different types of cancers, but you can just pick one, like melanoma, which is fairly basic skin cancer. And I have no idea how many different cancer researchers are focused on this right now. So let's just make up a number. Let's say it's like 5,000. I have no clue if that's the right number or not. So don't take me to, and don't, but
we'll not coach you on it.
Don't quote me on it. But if you can create AI scientists and have them each focused on very specific aspects of solving that, and instead of having, a few thousand researchers, you can have billions and you can replicate them over and over and over again. You're probably going to find solutions much faster than how we're doing things today. And so it really comes down to the power of the models, how accurate they are, and giving them access to the data. So I think most of these researchers probably don't have access to every single study that's ever been done and being able to analyze, those studies to see how they should evolve in their thinking. But an AI agent can have access to everything and be able to analyze it constantly. And if there's a new study that comes out, integrate that into their process. And so I think there's going to be profound discoveries over the next decade from these AI scientists. I think the question in my mind is, are these vertical specific ones going to succeed, or are the Geminis of the world going to succeed?
Yeah, that's the big question.
And that's the big question, which I don't know what the answer is. It's probably both, but it does feel like the horizontal LLMs might have an advantage, because the more money you spend on compute, the more data you have access to. If you're going vertical and owning the entire stack like Google is, you have a massive advantage. And so there's a cost advantage there.
Right. The innovator's dilemma is also a very real thing, which Google hasn't completely proved wrong so far. But that's also, I guess I think in the early innings of the AI investing cycle, at least, there was this one line of thought that the modern, I guess like the cycles for innovator's dilemma have shortened, and there's these AI super labs are focused on different things, and they won't catch up to these vertical problems, and they won't be able to focus on each of them. But we've seen the reality being very different than that, right? Like where if it's a coding co-pilot, each of them end up launching, and the vertical startup that was using underlying different models to to launch something, there might be one winner like Cursor, but the other four might not survive because Claude Code is so good, or because OpenAI has Operator. And the same thing like with science, like you're right, like we don't know yet, but that just more resources might end up defining it.
Yeah, I'm an example of this. Everybody's heard these stories before, but a startup, raised like $50 million to build this model. It took them 2 years to build it. They tested it against ChatGPT, and ChatGPT was better. And so it's like they just spent $50 million for nothing.
Yeah.
And I think it's, that's the challenging piece, right? Like you just don't have the same sort of resources as these horizontal models and access to compute.
So how do you, compute seems to be a very real challenge here in unlocking, I guess, the same sort of, I guess like if compute gets solved, which is a whole multi-trillion dollar company on its own, right? That just like completely changes the playing field for startups.
Yeah, I think obviously you can look at this data, but the cost of compute is going down. And I think that, the amount of energy that these chips need is going to go down substantially. And so I do believe that it will be much cheaper for these startups to access compute in the future. But these models might just be so powerful that you don't need a lot of these vertical specific, companies out there today. They might already be too far ahead of you by that time.
The super labs might be like way too far ahead. Yeah. Well, I think the other conversation that would be interesting to have is like the services model in venture. And we were talking about this a little bit in the morning. 16 years ago when you started, multi-stage firms or venture firms in general probably did not have operator investors or platform teams, which offered talent recruitment, exec recruitment, network building through events and different programming, and all sorts of these fundraising support. Like there's all sorts of support, right? How do you see that evolving in the ecosystem? Do founders find it useful? Is it too much of it now? Where are we at in that cycle?
That's a great question. Well, one thing that we've really been focused on is helping our founders raise subsequent rounds of funding. And so I've invested in hundreds of companies over the years. And what I found with the founders that I work with is, there's different, bounds of funds. There's the tier 1 funds, there's the tier 2 funds, and there's the tier 3 funds. And if they get, multiple term sheets from the tier 1 funds, they tend not to care so much about the platform and the services. They care more about the partner that they're going to be working with. And does that partner have experience in the sector that they're building a business? And if that person had built and operated a company before in a similar sector and they think they can learn a lot from that individual, then they tend to gravitate towards them. Or they just want the highest valuation that a fund in a tier 1, is going to give them. And so we haven't found that founders really care so much about the platforms. And then once they do invest, whether it's a fund with a big platform or a fund with a small platform, what we found is it's very hard to have specialists in every single vertical. And so if you're in logistics, it's a very different type of help that you need than enterprise SaaS or consumer or digital health. And so unless you're kind of within the sweet spot of the individuals that they hired at that fund, what we found is, they tend not to be that helpful. What's helpful for them is if they're doing enterprise SaaS and they have somebody that's like kind of a networked, customer, like person that can make a bunch of introductions to potential customers for them, that's super helpful. Or if it's a recruiter that has specialized in go-to-market and salespeople in that space, then that's super helpful. But most of the time, they don't have that specialty.
And you mentioned that you started out organizing a lot of events, which I do think founders get value out of. But I think you brought up an interesting point too, which was that the founders who, I guess the founders who are doing really, really well, or whose companies start doing really, really well, don't find the time to come to these events, right? But I'm sure that was not the case. That was not always the case, right? Like events were valuable. There were far and few in between. And so,
yeah, when we first started, we did a lot of events. We did a bunch of dinners. We did a retreat every year at a ski resort. We would try and bring our founders together as much as we possibly could.
Yeah.
And I think our founders got a lot of value from it. But at the time, they weren't getting invitations every single week from every single fund. And so it was easier to kind of pull the higher quality founders, which would be draw and gravity for other founders to come to kind of sell into those larger businesses. And what we found today is there's just a lot more competition. Every single fund is doing events. Companies are doing events. Media is doing events. And so if you're a high quality founder, you're getting an invitation literally every single week, if not every single day, to go to something. And you have to manage your time and your bandwidth, and you only have so much capacity on a weekly basis to go to these things. And so there needs to be like a massive draw to get you there. And I think if it's, amazing founders that are going to be at these events or potential customers for you, then, these founders will go. But I think in general, it's become much more challenging to bring in, the high caliber founders to these events because they're just spread so thin.
So in 2026, as you have your new fund, is the thesis, we're not going to do any events, we're not going to do any conferences, we're just going to try to see what the founder actually needs and help them get that, and everybody else is doing the rest anyway?
No. So I think I don't want to be a hypocrite, but I think our strategy is to do 1 to 2 events, make them extremely high caliber with top founders, really great speakers, customers, potential investors, but make it really valuable for the founders to come instead of doing a bunch of events. Focus on quality over quantity to make sure that the events that we do really add value to our founders.
Yeah, that makes sense. But even as you narrow down to the super high quality events, right? I think the frequency of those from like media, other firms, other networks has also gone up, right? You have all these membership only networks for CEOs now, which are a lot of them are getting started by former founders who are very successful. You have media that is like, or tech media, let's say tech media is, very involved in they bringing together a lot of the same stakeholders. So as competition for that increases, how do you how do you see the VC firm providing value?
Yeah, I think it's challenging.
Yeah.
No question about it. For us, it's about finding anchors that can add gravity to the event. Or if I have 4 high quality organizations that are part of it as potential customers, as thought leaders, and as somebody that these founders might want to learn from, and then kind of building on top of that foundation is what we try and do, and keeping it tight. We don't need to have a huge number of people come. We just need to have the people that are meaningful to our fund and meaningful to our founders be there for them.
I think there's going to be some sort of reversion to the cottage-like industry vibes where there are going to be way more collaborations. There are going to be way more collaborations amongst like-minded firms, people. I hope
so, yeah.
Because it just won't be sustainable because there's so much competition.
Yeah.
Because like everybody's competing with their friends all the time eventually, right? And they're going to be like, you know what? It might make sense next year to just collaborate for this thing. And
that's what it used to be like.
Yeah,
I think when I first started investing, it was very collaborative. You talk to other funds all the time. You'd host events with them.
Yeah.
You're constantly doing things with other investors. Those investors became some of your closest friends. And I think, things have really changed over the past 16 years.
How do you make friends now?
That's a good question. Challenge. No. Yeah, it's, you can't go to all these events and hang out with the other investors like you used to. They're your competition.
Yeah.
No, I think there's like a commonality between investors where it's like you're kind of all doing the same thing. And so everybody respects each other. Also, most funds do multiple different stages. So if I do one stage, my friend can do the next stage.
Yeah.
Somebody might do a stage in front of me. So I think it's pretty easy to be friendly with a bunch of investors and trade deal flow with them.
Well, because there's 900 of them,
there's a lot of seed
you'll find some friends.
Yeah. There's a lot of
there's more of them. That's interesting. Well, you haven't really caught on the Twitter zeitgeist. That's a proper phenomenon now, right? Where newer investors are chronically online, they're building following, they're, media is the strategy, whether that's through writing, through podcasting, blogging, events, I guess you could say, but it's like very specific. I think events are very entrepreneurial in nature where you create something out of nothing and they're very high value, very hard to pull off. I think the barrier to just doing that is still very high, but everything else, I'm not saying it's not hard to do. Of course, it's still very hard to do, but you don't tend to do a lot of it.
Yeah, so I've never been a big poster on social media, tweeting or putting stuff on X or, any of the other like platforms, LinkedIn, et cetera. I've been mostly just focusing on investing. And I think that investing is incredibly difficult. You only have so much time during the day. And so if you're meeting with founders, you're supporting founders, you're talking to LPs, you're researching different industries. My feeling is it's very hard to have the time to kind of, build up an online presence. Obviously, there's been a lot of successful investors that have been able to do this and are focused on it. It just hasn't been one of my focuses. My focus has always been on do the best deals possible, support those founders and have those founders speak highly about you to new founders and create a flywheel that brings in deal flow.
So would you say even now, 2026, when there are all sorts of, outrageous budgets being allocated, we're probably not far away from the Silicon Valley version of Hollywood in venture, where we're producing, the new TV shows in tech, we're producing the new movies in tech. I say this jokingly, but, we might see this happen. But you think still like the, bottom line is the founder needs to find value. It needs to, speak highly of you. You need, if you've done a good deal.
I think there's a lot of paths to
Right.
success. I don't think there's like, one way of doing things. I think there's millions,
But
endless.
fair. Yeah.
And so I think everybody kind of
Yeah.
chooses their own path on what's best for them.
Yeah.
I think you can definitely be like a social media star and post tons. There's a lot of people, I mean, I don't have to like name their names,
Yeah.
that are just focused on that. And they get a lot of deal flow.
Oh yeah.
They get
yeah.
tremendous amount of deal flow.
Yeah.
And so I think that is, a good approach. I think there's lots of different approaches. You can do a lot of deals and take more of an index approach. You can do a very few number of deals. You can do one deal and be super successful.
Yeah.
And so I think there's lots of different paths to success, and that, you have to choose your own and what feels
Right.
authentic to you.
To you. Yeah. That makes sense. How do you allocate your time, or how's that evolved over the last like 16 years?
Yeah. So we feel like the founder is our customer, and we want to service the founder to the highest possible way that we can to support them. And so if they need something, recruiting help, go to market, cultural issue, fundraising, whatever, there's thousands of different things that they might need, trying to be there for them and respond quickly to them. And if we can't help them, point them in a direction to somebody that can. And so a lot of it is just putting out fires. This company needs support. This company needs help. This like CTO isn't working. What can we do to support these businesses to get them to the next level, and being available for them? I think that is the number one thing that we're doing on a daily basis. But for us, it's prospecting for deals, doing market mapping, understanding different like areas that interest us, trying to talk to as many companies as possible in those sectors, doing a bunch of customer calls to see which of these companies have a superior product to the other ones. Do they have a better go-to-market motion? Do they have a better team? What makes them unique? And then trying to win deals within those spaces, and try and get to companies before other investors do. Because the reality is, any great company that's running a competitive process, if they're talking to 20 funds, 19 of them are going to lose and one of them is going to win. And so we want to try and get to these founders before they start, running a process, building a relationship with them, and trying to invest at the earliest stage possible once they have some form of product market fit.
It's a very tough combo.
It's very tough.
Almost
impossible.
Oh yeah, almost impossible. So what's the art of like getting that relationship started early?
So I think the key thing is, and every single fund does this, this is not secret sauce, is doing a lot of customer calls, really understanding, how this product is positioned, what makes it unique. Does it truly solve like an enormous problem? Is it 10x better than the next solution, or just 10% better? Or do they have some really unique go-to-market motion that none of their other competitors have? And so kind of doing a lot of work before we even go speak to the founder, and then coming with a prepared mind of, hey, this is a deal that we want to do. What can we do to kind of try and sell this entrepreneur on wanting to work with us? And typically that's a lot of customer intros or figuring out what problems they have and, trying to help them solve it. And if we can help them solve something, then they're sometimes, not all the time, sometimes more willing to take our capital, but not all the time.
When you say customer calls, do you mean you're looking at what like these 5 companies in a particular space, who are they selling to, and you're good talk to all their customers and figure out what products they use and why they use them? And
yeah, the best customer calls to have are the ones that.
And so you're doing this without asking the founders for those customer intros. You're just like doing this on your own.
Yeah, but it could be companies that aren't even customers of theirs. So it could be a company that is looking to use a product like theirs and have researched all the different competitors.
Yeah.
And they say, hey, these 3 are really interesting. We're thinking about using this one. Or it could be one that a company that is using that product, but evaluated, 5 other businesses that were similar. So it can kind of go both ways. We might do a ton of customer calls and nobody's heard of the product before.
Right.
And it's like, okay, this team is not doing a good job marketing this business or building mind share. Maybe they just haven't been able to like set up a call or sell this business, but they should be aware of this company.
Right.
And so if they're not even aware of it, that tells us something as well.
Oh, interesting. So, and obviously that takes a lot of time. So if you're posting all the time, you might not get time for that. And I guess that's like it's just a different style, as you said earlier, right? And you said one approach, I guess, towards investing would be building an index. Right? What do you mean by that? Is it like having a product offering for the LPs, which are your other customers, which is the equivalent of a S&P 500, just performs a little bit better? Is that what you mean? Can you break that down? What is that approach?
So I think the index approach is doing I wouldn't say as many deals as you can, but I would say, kind of blanketing a specific vertical where you try and get into all the companies that are focusing on very specific areas.
Right.
And sometimes they're competitive with each other, sometimes they're not. And writing fairly small checks, not being on the board, and effectively kind of just being along for the ride. This could be like 50 or 100 deals per year within a fund. And basically, if the founders and the product meet a certain criteria, you invest. And you can almost think of like YC as like an index fund too.
Oh, yeah.
I think,
in a way,
I think when I first started going to YC, I thought of them as like, this incubator that was, trying to help like the overall like entrepreneurial ecosystem, which I think they are. But I see them now more of a fund, more of an index fund. And they're trying to get in as many high quality deals for as low of a price as possible, support those businesses. And they have an amazing network to do so with an incredible entrepreneurial network, and then access to the best investors in the world, and then have them raise at a much higher valuation. But I think they're, effectively an index.
That's a very good analogy. And well, as you brought up YC and how it's evolved over the last 20 years, I guess startups as a cultural movement, entrepreneurship as a cultural movement has really evolved in the last 16, 20 years since you started going to those 12 people demo days as well, right? Now it's almost like, this is my perception of it, right? Being a venture-backed founder is the equivalent of a Harvard MBA.
I think if you took money from like a high quality fund, if you got money from Sequoia, yes, I agree.
Yeah, yes. If you, but like, that's almost like, that's the aspiration of most talented people coming out. Whereas maybe not everybody should go and be an entrepreneur. Right. And you did like, I guess like define this in a way that some people just want to start a company and some people want to solve a problem. But I think in the current environment, a lot of people who want to just start companies are also getting funded.
Yeah. I mean, 100%. And I think there's just so much capital out there that if you're a pedigreed person, it's just not that hard to fundraise. And it's not that hard to raise huge amounts of capital at seed to try out lots of different types of businesses and ideas. And, their hope is they're going to be the next, OpenAI or Anthropic or Cursor or
Airbnb.
Yeah. I mean, there's so many different examples, and I think everybody deserves, a chance to try. So I wouldn't say don't start a company. I think do start a company. I would just do a bunch of research to try and figure out what company and what type of business you want to start. so that you're not spinning your wheels once you get funding, because the clock starts when you take the money. And, you can say that you're in the weeds or you're going to a tunnel. And then at some point in time, you get out of the tunnel and you see the light, and seeing the light is having customers and a product that people want. And then it's like, okay, I know which direction to run. But when you're in kind of a dark space, sometimes you don't know which direction to go. And I think once you see the light, you kind of understand which direction you should be running towards.
When you're not going after a specific problem, you've thought very long about, let's say, we had Brandon Sorbum, who's the co-founder of Commonwealth Fusion Systems, on the podcast, right? Commonwealth Fusion Systems is almost the size of most national fusion labs, right? That in terms of, I guess, the money they've raised and stuff, right? The founding team, I guess he'd been working on it for about 3 years leading up to starting the company. They tried going after the same problem from many different angles. And he told a story on the pod where he mentioned that they first tried starting a nonprofit institute because they ran out of funding. Like, the funding got cut, and from NSF, the funding got cut for their program. So they went out fundraising for it. And then they had to learn how to lobby congressmen, and they had to figure out a lot of stuff, right? But they wanted to get their funding revived. But they picked up this art and skill of lobbying during that time, and, creating a coalition of supporters around that time. And through that process, they learned that, and they also started going to high net worth individuals, billionaires, etc. And once they went to them, they learned that, the nonprofit institute is probably not the best way to do this, because this could be commercially, if it works, a huge opportunity. So they got feedback from the market that, oh no, right, maybe you should just start a company. And they didn't agree with the thesis at the time, or like the feedback at the time. And now they're 3 years into it, towards the end of their PhD. And now they're like, okay, you know what? This is the problem we're obsessed with. This is what we think is transformative, what we've discovered here. We should just go out and start a company. So this is like I'm sharing this example as a team who, is going after a specific problem. And then, there are companies that probably iterate 10 times. And sometimes they find success, but I don't know if they're the generational SpaceX type companies that started with a thesis.
Yeah. I mean,
I'm probably oversimplifying, but like, what have you seen?
I feel like some of the best companies have pivoted into it. I think that Cursor didn't start off as
that's a fair point. Yeah.
Right?
Yeah.
Slack, I think, was a gaming company. Was a gaming company before they went into, messaging and communications. So I think a lot of the best businesses, they had a strong founding team, and they finally found a product that works. And so I think the lesson learned there is you shouldn't stick with a product that is not working.
Oh yeah.
If you've gone 100%. Down a path and the product doesn't work, the position doesn't work, something isn't working in your business, you should change as quickly as you possibly can, because you're only wasting, your own time.
Yeah.
And you only live so long. So you should be focused on something that's actually working versus trying to put a square peg into a round hole.
Should you try to return capital and start a new company in that case, or just try to pivot the same company? Because you've built the DNA of the company in a different way, right? Like for that specific.
I think it really depends. Every situation is different. Yeah. We've had companies that pivoted into new businesses. We've had companies that shut down and gave capital back. It tends to be something where you have maybe 3 at-bats where you do one idea, it doesn't work. You do a second idea, it doesn't work. You do a third idea, it doesn't work. You should probably return back the capital. I don't think it's something where it's you have an endless number of at-bats to kind of really try to build a business.
Yeah.
Because at some point in time, that money is probably best used in other places.
Mhm.
And the investors have been patient enough for you to try out lots of different scenarios.
And I guess like retaining that trust is like more valuable because then you get to
Yeah, you
come
can
back
do,
and do other
yeah,
things.
if it's like, hey, this
Yeah.
didn't work, well, bring us another idea. But typically investors invested you in some sort of framework of ideas that they think you're going to achieve. But there's so many examples of companies pivoting into great businesses.
And we've had like Colin Greenspan, who's a co-investor with you in Chapter. We've had Cobi on the podcast as well. We ended up having a whole conversation around thesis-driven investing because that's his framework, which is he would take a significant time to develop a thesis around an industry. And then I guess very similar to you, where you do a lot of customer calls and you develop a thesis around an industry and go try to find companies, who are working there that you'd like to be a part of, or founders, that you'd like to work with. Is in that case, that thesis for the problem, right, is I guess like how you get there is less relevant, and if it's 3 iterations along the way in that specific scenario, right? Is it that you're very convinced about your thesis for that particular opportunity or problem, and how you get there is like a big question mark, right? And you see if there are 3 different approaches and 3 different product offerings, different positioning, what it is, but the broader thesis is, the North Star is very clear. That is different to probably a product looking for a problem, right? Just to clarify, right?
Well, I think there's you can hit anyway, right? I think sometimes, and this is a problem that we run into all the time, where you do a bunch of marketing mapping, you have a thesis, but you don't find like the right team or the right company that's building within that thesis. And so you spend all this time developing the thesis, but you just never find the right company to invest in. Or, there are some really interesting companies to invest in, but you don't win the deals and you can't get into them.
Or the price doesn't make sense.
Or the price doesn't make sense.
Do you then have the itch to incubate?
Yeah, I think incubation is really interesting because we kind of talked about this at breakfast, but we haven't talked about it here. There is so much dilution from seed to exit. These companies now that have a lot of success, they tend to burn more capital to grow faster. But when you're burning more capital, you need to raise more money. And as you do more rounds, larger rounds, there's just a massive amount of dilution from formation to exit. It's probably close to 90% dilution. Sometimes it's less, sometimes it's more, but 90%, if you owned 100%, now you own 10%, that's a huge number.
Yeah.
And so when you're a seed investor and you're owning like 2% or 10% of a company, and at exit, you're owning 0.1 to 1% of a company, it's very hard to return your fund. And so if you incubate a business, you can own 20, 30% of it at the beginning. You don't want to own too much because then the team isn't highly incentivized to be working on this day in and day out. But if you own enough of it, you can still own a decent amount of the company at exit. I think the bigger thing about incubation is that you really feel like you're a part of the journey.
Yeah.
And, you get to feel rewarded as the business really succeeds because you're much more heavily involved in the company. And so I think incubation is super compelling. I think for almost any investor, it's just a bandwidth question of it is so much more time incubating than it is just investing in a business.
Have you thought about doing incubations with the new fund?
Yeah, I mean, I think that's definitely something that we will look at, is incubating some businesses. It'll be a very small number, but we've always tried. I've always tried to incubate businesses through the years. Maybe not with the amount of success as some other investors, but that's something that we'll definitely be focused on.
I think it's the process of going through that gives you so much insight about the market that it almost prepares you for, the right opportunity down the line. We had Sebastian Kaliu from 8VC on as well. 8VC is known for doing a ton of incubations, build program. And I spoke to one of the partners at Idea Lab as well, who, I don't know if you know this, but I think they've done 35 or 36 IPOs out of 200 incubations. It's just insane. And then we had Bharat Vasan on, who, I don't know if you know him, but he worked with David Friedberg at the production board. He was a partner there. They did deep tech incubation specifically, which is a whole different level of challenge. And from those conversations, like the common thread was something you referred to, team incentives. That was one part of it. The other was finding that talent, right? Like it's like whole different challenge on its own. And I guess across all those conversations, the common answer I got was it takes 2 to 3 years to find the right team when you're incubating. So the question that pops in my head, and I asked this earlier as well when we were talking about building in the physical world, was that is there, enough talent out there?
Yeah. I mean, I think there's always enough talent out there. I think it's just finding it.
Is it discoverability?
Yeah, it's discoverability. But I think sometimes the most talented people have broken resumes.
Oh yeah, 100%.
Yeah, and they work harder.
They don't check the boxes. They don't the credentials aren't there.
And it's harder to find those people.
Yeah.
And I think some people that are pedigreed, everything has always come to them.
Yeah.
And so they don't really have that like gut instinct or that ability to work super, super hard or be heavily incentivized. They don't have the chip on their shoulder that they need to make this work.
So almost the opposite archetype is more suited to incubations.
Sometimes. So I think being able to identify talent is extremely difficult.
Oh yeah.
And I think this is not only in the tech ecosystem, we talked about in sports too, right? Whether you're a coach in the NBA or the NFL or within the NCAA, I think it's always about identifying talent. And one thing that we spoke about earlier today is it's a very different skill set, building a product and building a team and making that team, successful. It's just two totally different things. And so I think that, if you're really good at identifying talent, recruiting talent, shepherding talent, you're probably going to be successful. And that is something that most founders are not focused on, and they should be much more focused on.
Though, yeah, 100%. What have you learned about venture is also like identifying talent, right? That's the business in a way. What have you learned about identifying talent?
Yeah, I think that you want somebody that is extremely persistent, that is going to run through walls to make things happen.
Do you have a story you can share on camera of like a founder that was persistent in some unique way?
Yeah, I mean, I think I have so many. I think Cobi's a great example from Chapter. I think that he works extremely hard. I think the one thing about Cobi is like, if you text him, no matter what time of day or night, he's literally always awake.
Oh yeah.
And he texts you back immediately. Even if he's in like an important meeting, he's like, here's what you need. Here's how you can help. He's always working.
Time to action is insane.
Yeah. And and if you send something to him, he executes on it very, very fast. Whereas some other founders I've seen, it takes them a while to respond. They seem like they don't have enough bandwidth. It's hard for them to get you answers. You ask them for, updated numbers or what's happening in the business, and they have to collate it from, different parts of the company. With Cobi, it's like, it's always at his fingertips. He knows everything.
Yeah. So urgency is part of the DNA.
Yeah. Urgency is part of the DNA, where it's like, you have to be able to get things done quickly. And you have to have like a very high comprehension of what's happening within your business on a daily basis. And I think that he's really shown that. That's one characteristic. I think that the other thing is just never giving up. just trying to find a way to make it work, right? And I've had a lot of founders that will literally take like 20 or 30 different angles to find a solution, and they'll finally take one. And then founders that will just kind of give up. Oh, this is not working.
Yeah.
I'm just going to like give up here. Like, I don't know what to do. And there's other founders that feel they can't give up, that they need to keep on going and they need to find a solution, and that failure is not an option.
Yeah, one of my friends says this, that a lot of companies die not because they, run out of funding, but because founders lose optimism. And that seems to resonate. And I think like I've heard this failure is not an option. I've heard versions of this before. What do you mean by that? Like,
yeah, I think there's one reason why immigrants are such successful founders is they feel like they have to succeed, that their whole life is wrapped around this business. And if they don't succeed, they're not going to be able to support their families. They're not going to be able to live like their American dream or wherever they happen to be. And so they just figure out a way to win. And it might not be with the current idea. It might be figuring out a different idea to focus on. But this mental idea that I cannot fail. I need to figure out a path to move this forward. And I think that forces you to make better decisions or to cut ties with like certain business lines or ideas or people that might not be working. Whereas somebody that has a safety net and doesn't feel like it's the end all be all of their life to succeed, it's like, okay, I tried this, it didn't work, I'm just going to move on. I can just go work at Google or Meta or Robinhood,
right?
And do something else, or go work at a venture fund,
right?
And invest. And, I tried, but it just didn't work.
Right. So I guess this would vary from personality type, but immigrants, since like moving a country is in a way an entrepreneurial journey, you've completely uprooted your life, you're starting from scratch, and a company is you starting and creating things from scratch. So there's some parallels there, and your worst case scenario is a whole lot different.
Yeah, it's a totally different scenario.
Totally different.
Totally different scenario.
Yeah. That makes sense. So where are we in the state of, we've talked about a little bit about how incubations make more sense from an ownership perspective, how for you now doing later stage A and above rounds makes a lot more sense in terms of the opportunity available, since there's so much competition at the seed stage. Is it, what state are we in the seed and pre-seed era?
That's a really good question.
While you're at it, can you also share a little bit about history of how pre-seed is almost super angel check investing? From hearing from you, right? Like the pre-seed checks are 50 to 250K. This sound like angel investing back in the day.
Yeah, I think what happened was, it used to be there was like this friends and family round, which would qualify as pre-seed, but it wasn't institutionalized. Where literally you go out to your like uncles and cousins and best friends, and you'd raise some money, maybe like a couple $100,000 or $50,000, not a lot, and stand up a business. And then you would go to raise like a seed fund or potentially even a Series A back in the day. And I think what's happened is everything has gone earlier. So what used to be seed, is now Series A. And what used to be pre-seed is now seed. And I think the crunch has been like pre-seed and seed is now the same.
Yeah.
And there's no real difference between seed and pre-seed. And everything is just like basically pre-seed. And Series A is almost like seed, where it's like 100,000 to $1 million in revenue, maybe 2.5 million in revenue, depending on the business. And everybody's competing to get into the best deals. And so they're going earlier and earlier. But some of the big like multi-stage funds that have phenomenal brands, they'll wait and be patient and make sure that they really have the numbers to invest first. But I'd say the majority of them invest at as early stage as possible to get their ownership up front in any team that they have any sort of conviction in whatsoever, even if it's a small amount.
Yeah, no, that's an interesting framing that pre-seed and seed has become same, which means these pre-seed checks are like scout checks, and they're tracking if they should. I guess it's a way to track if you could do seed or A, right, later down the line, and the A's are really the seed. So that's how the market has shifted. But another way we were talking about this was the market has shifted as less liquidity. You mentioned 6 or 8 out of your 22 angel investments, exited within 2 or 3 years. And now companies stay private longer. You can't go acquire these for 50 to 100 mil because a seed valuation is 50 mil, right? So like from an acquirer's perspective, acquiring a ton of these doesn't make sense anymore. And that's part of the reason you mentioned why these acquisitions are not as frequent, right? And the nature of it has changed. How do you think that has impacted the ecosystem?
Yeah, well, I think first of all, it's very hard to predict what the world's going to be like in 2 to 3 years. It's virtually impossible to predict what it's going to be like in 15 to 16 years.
Yeah.
And when you're investing in these pre-seed companies today, the duration of time to exit is so far in the future. It's virtually impossible to understand what's going to be happening at that point in time. I think from an M&A perspective, there's like usually 2 to 3 different reasons that you're acquiring a company. It's strategic, and you can plug in that technology into that company's distribution and, expand it pretty rapidly. They are buying it from a defense mechanism where they don't want that other product to exist to compete with them. They're acquiring it for talent, or they're acquiring it for the traction, and it has material revenue and profits. I would say material profits isn't usually in the conversation with most of these businesses, unless it's like being acquired by a private equity firm, because they can typically like go public if they're on that trajectory. And so what tends to happen is, these businesses don't want to buy at a premium multiple for whatever reason. They raised at a fairly high valuation in their last round, and they don't want to sell at a lower valuation. And we've had multiple examples where a company got an acquisition offer for $50 to $70 million by a great company, but their last round was done at 150 or 200.
Yeah.
And they're like, we don't want to sell at half our valuation.
Yeah.
And I think the thing that a lot of these founders don't understand is that, if you hit terminal velocity and you're growing like a weed, you should definitely not sell. Okay. You should definitely, try and figure out if this is going to be like a massive business. But if you haven't hit terminal velocity and you're not growing that quickly, and you don't have great capital efficiency, and your go-to-market motion isn't completely working yet, then, the last round valuation isn't what you're really valued at. It was just, a factor of competition from VCs trying to invest in your round, and where they thought a potential outcome could be from there if everything, worked out and was aligned. And so sometimes the right answer is to sell for $50 to $70 million. But when I was investing 16 years ago, if we invested at a $5 or $10 million valuation and, it got an acquisition offer for 60, that was a phenomenal outcome. Everybody was really excited.
Yeah. Especially if you didn't get diluted further, right? Like that was the last round you did, and that's a phenomenal outcome for the fund. Oh. I wish we could go back to those days.
Yeah.
And what's the most contrarian philosophy you have around investing?
Yeah, I think that there's a horde mentality towards investing where everybody typically is investing in the same sort of super cycles, where obviously now it's mostly vertical AI and AI infrastructure. And so I think Peter Thiel has done an amazing job of taking contrarian bets and investing in areas where people aren't looking at investing in. And so I've always like tried to pick like one or two areas that, you know, I don't think the investing world is looking at today, but, you know, they might in the future. And so early on, like, you know, 14 years ago, one of my bets was just in computer vision. I felt like there was a major inflection point with these neural networks that Google did with DARPA and their autonomous vehicle project, and using it for medical imaging. And so I started trying to invest in a bunch of companies within medical imaging where computer vision would really affect it. I think I was probably too early in a lot of the companies. And so timing, I do think, is very important. And so understanding, you know, where, you know, timing is at any point. Right now, some things that we're looking at are food. You know, I think that, you know, was a hot area to invest in, not as hot anymore. I think there's a lot of things that AI is going to affect.
Yeah.
But, you know, I think, you know, whether it's the distribution, the logistics, the AI components of it, the agriculture components of it, I think there are a lot of opportunities still there. I think you just have to be very precise on where you're going to invest. I think agriculture tech is very challenging because there's not a lot of potential acquirers of those businesses, and they haven't shown that they want to acquire technology companies. And so if you are going to invest in it, it has to be a business that can IPO and be an enormous winner in the space. But I do think there's a lot of opportunity there, and it's, you know, a space that a lot of investors are not looking at today.
Yeah, I had Rob Leclerc on the show. He founded AgFunder, and yeah, we spoke about how hard the biggest exit has been probably to Monsanto, Friedberg's company, the Climate Corp, was the biggest exit in the space, and that's pretty much it in the last 10 years. But that might be precisely why it's interesting.
Yeah.
We hear this a lot, that you go eat in Europe and actually feel it. If you go eat in Europe, you know, you don't feel as bloated, or you don't feel bloated at all. The amount of substances banned, the list is like way longer. And why is it even allowed in the US? There are all sorts of things, whether you think that's a function of regulatory environment, that's a function of you know, what you need to produce at scale to meet the demands in America. Like, what is it? Like, everything starts from good intention, right? Like everything, if you didn't have all the technology, we wouldn't be able to meet modern demands.
Yeah. I think it's everything you said. I think it's regulatory. There should be substances that should definitely be banned. Yeah. I think that, you know, margin is a big piece of this. And, you know, whether you're a restaurateur or grocery store, you know, you want to get, you know, the cheapest products and sell them for the highest price.
Yeah.
Right. And, you know, products that are mass produced tend to be cheaper to buy.
Yeah.
And so most like food items in the US are mass produced. I also think there's a lot of co-packaging where it's like you have different brands, but they're all being packaged with the same ingredients at the same factories, and just have different, you know, kind of brand labels on them. And so that's a big issue. I think in Europe, they tend to do a lot more organic farming.
Actual organic
farming. They tend to have a lot more substances banned, but they just care more about their food. Yeah. It's a big thing for them to have clean food in most of these areas. And I think it's more hyper local as well. Whereas in the United States, it's, you know, industrial food manufacturing. Yeah. And it's very hard to get away from it, even if you want to.
Maybe there's some opportunity here where there's an Uber for local producers or something.
Yeah.
Or like a, you know,
it'd be cool.
Some sort of local congregator of, you know, these local hubs. And I don't know exactly how, it would be incredibly hard to execute how that would work.
Yeah. No, I mean, I think you're onto something. I think, you know, there's been a lot of like companies that have tried to start in this space. I think it's more of like giving the farmers the tools to like try and produce organically. I think that, you know, a lot of people have tried to do this with like modern autonomous tractors that would de-weed. And so you wouldn't use pesticides to de-weed. And I think as like a lot of these platforms become more autonomous in nature, it's going to be easier to do this. And I think we are at, you know, this tipping point where you're not going to need to have like custom made equipment to do all this stuff. Maybe it's a humanoid robotic. Maybe it's, you know, you put a robotic arm on a tractor that can do this. But I think that, you know, the foundations are being laid for not only just agriculture, but construction and manufacturing to really revolutionize like how each of these businesses operate. And a lot of the labor that people don't want to do, whether it's like picking fruits or de-weeding, they want to be focused on other things within the operation, can be done with robotics in the future. And we invest in a lot of this stuff like 6-7 years ago. We were just too early. And I think the timing is getting to be right about now. And so just because, you know, we're too early for that wave doesn't mean that the wave isn't coming.
Yeah. You talked about timing, like you brought up timing, like, you know, on 2 occasions now. Can you break that down? What being wrong on timing means, I guess, for the venture capital business, but, you know, on the long run, you're still like probably right? Like for the medical imaging space, on a, let's say on a 5 to 7 year horizon, you're probably not right, but on a 15-year horizon, you are. And it could be different timescales for different technologies, businesses, right? So if you're eventually right, does that never get rewarded?
Yeah. Well, I mean, Jeff Bezos uses this example of like a surfer and a wave coming, but I think it's actually like a great analogy. And if you're in front of the wave and the wave is coming, if you catch the wave, you know, you hit a winner. Now, a wave can be coming and you're a surfer and you still missed the wave, right? You didn't catch the wave and you missed it. And it's like you had the opportunity, but you didn't get it.
Right.
Or you're in back of the wave. And when you're in back of the wave, there's no way you're ever going to catch it. And so it's this question of, has the wave passed you? Or is the wave still in back of you and you still have a chance of catching it? Right. And I think sometimes as investors, we're so far in front of the wave and the wave isn't coming for 10 more years that, you know, we're just never going to catch it unless we're patient enough. And I think there's so many examples of this. I think in the VR, AR space, virtual reality, augmented reality, I think, you know, people thought that was just going to be absolutely massive. Yeah. You know, that was probably 10 years ago. I remember when Google Glasses came out. If you look at Meta sales of their Ray-Ban Meta sunglasses, I think they sold like 4 or 5 million pairs last year. And I think maybe they'll sell 20 or 30 million this year. And I think Google's coming out again with
Apple Vision Pro. That was, I guess that reignited everyone's excitement about the space.
Yeah. But I do think I think with VR, the VR moment might be happening in 2026 or 2027. I think that my prediction is in the next year and a half, 100 million pairs of eyewear will be sold across this ecosystem that are connected to AI. you can put that on Polymarket and see, if people want to bet on that. But that's my prediction. So this VR market finally is getting here. It's not totally there, but maybe now is the time to invest in VR.
Right.
It wasn't 10 years ago.
Maybe not even 3 years ago.
And maybe not even 3 years ago. And so timing is literally everything in venture. And if you get it too late, you invested in a social network, in 2012 or 2014, you're probably too late. Everything was done between like 2000 to 2010.
What about the investors in MySpace and Orkut?
They're too early. And they didn't, I don't think they adapted to the times. I think they had the opportunity. They just didn't evolve the business. And maybe with MySpace, if it had never sold to Fox, it maybe would have had some success. I think they maybe sold it too early, but they could have been, the Facebook of this era.
Yeah. So timing is everything.
Timing is everything.
But it's impossible to figure out.
Impossible.
Well, from being too early, what have you learned about spotting it now?
Yeah.
Or like catching it?
So I think that comes to the reason why I want to focus more, why I have been focusing more on Series A and B and not seed, is seeing a product in market, talking to customers.
Feedback loop's just way quicker.
It's way quicker. I think the best producing, funds have been Series A and B funds. Their hit rates are just significantly higher. Yes, there are some seed funds that were like $8 million that had like crazy multiples, but they weren't putting real money to work. If you're putting real money to work, like hundreds of millions of dollars, the best performing funds have been these Series A and B funds because the hit rates, are much, much higher.
Yeah.
I know I just said that twice, but I want to make sure that I get it in people's brains. So, a lot of these like companies where they don't have any customers, they're still working on like a product to see if it works. Like I wouldn't do those again.
Yeah. Because
I don't know how long it's going to take them.
Yeah.
And how many rounds of funding it's going to take them to get them to their product to be working.
Yeah.
And so I'd rather just be patient and pay a higher valuation than to invest and be waiting 10 to 15 years. And the company most likely going out of business before then or being sold for scraps.
So around valuations, there's this other argument that comes up on the Twitter timeline that, yes, the valuations 10 years ago were lower and you were paying 6 to 8 million on average for seed rounds, but also the exits were lower, right? You were getting 60 to 80 million dollar acquisitions. And also the most valuable company at the time was probably worth 200 billion or 300 billion. Now you have
multi-trillion-dollar companies,
$4 trillion companies or something, right? And so the acquisition value has completely shifted as well. Sure, there are like
absolutely
like smaller acquisitions. So it's like irrelevant because no matter what point in time you live in, I guess inflation is the one thing you can count on is there will always be inflation.
Yeah.
One thing you can for sure bet on is 15 years from now, the dollar won't have same value.
Yeah.
I guess if the one thing you're going to bet on is that, right? So from that perspective, what I guess seems true is that the power law is going to be even stronger than ever.
I think you're already seeing that today.
Yeah, right? I guess so.
I mean, all these private market companies with like multi-$100 billion valuations, Anthropic, OpenAI, Stripe. And then other companies like Anduril, that might be there soon, right? In the private market. So a lot of private market valuations are extremely high, and the goalposts keep on moving. I think, you could go public when you're doing like 100, 150 million of revenue, 10 years ago, in the next 2 years, it might be, you have to be doing $1 billion of revenue. And growing like 30, 40% year over year with good capital efficiency to have the metrics to be able to go public. And so it keeps on changing, but that also makes it harder for these companies to exit.
Would this be the right contrarian thesis to run in the opposite direction and maybe IPO to create more liquidity events?
Yeah, I mean, yeah, to try and like reduce the goalposts for IPO candidates. Yeah. I think the issue. I think a lot of companies want to go public. I think the challenging thing is, they need public market analysts to cover their businesses, and these public market analysts will only cover these companies at a certain scale. And so, if you don't have public market analysts covering your business, then institutional investors, large institutional investors, don't want to buy those shares. I think AI might change that because it's a lot easier to do this analysis, and you might not need those public market analysts anymore. And then, a lot of these businesses could start going public much earlier. And I think that's, there's a high probability of that happening. And then there's also, this idea around tokenization, which we haven't really touched on yet. But, I think a lot of these platforms like a Robinhood or Coinbase, have talked about tokenization. Obviously, Robinhood came out in the EU and they have two products that they tokenized, SpaceX and OpenAI. I think they actually gave away the tokens to people that signed up for the platform there. But you could see, private market companies having tokenization play that allows, a retail investor to have a piece of the business. And so I think that could be super interesting.
That's essentially what ICOs were, but for the wrong reason.
Yeah.
Right. You're basically going public.
Yeah.
But
and I think retail investors deserve to be a part. A lot of these consumer businesses where they're the customer and they should be a part of the growth.
Oh yeah.
And it's not fair to them that these companies stay private and don't allow, these retail investors to participate in the wealth creation that these businesses are developing. And I think also the early employees, if you've been around for 10 plus years and you've cycled through like 4 or 5 different generations of employees, I don't think it's fair if like you are at a state where you can go public, you probably should. And it's only benefiting, a few individuals not to go public, but it'd benefit like a significant more amount of people. If you do, it probably makes sense to go public if you have the numbers.
I think we can come back to this, in like 2-3 years, but I think we're going to see more IPOs.
I think so too.
Yeah, we're going to see more IPOs.
I think so too.
It's smaller, not like, I
agree
think
with
like
you.
$5 to $10 billion range.
Yeah.
Especially in industries, that underlooked industries. Let's just call them that.
I totally agree. Cause I think you can do the analysis now much easier.
Yeah.
And so as these like analytical tools, which are like getting more and more powerful literally every single day.
Exactly.
Like in 6 months, they could be plenty powerful that you don't need public market.
You brought up that tool Tigas, right? Like if that is,
you can use that
10, 20x more powerful 2 years from now, combined with one of the super labs who has a tool for financial analysts, right? Which is going to come out. Eventually a dedicated tool is going to come out, maybe 3-4 competing tools. Then people in each of these industries can operate at 10x more productivity. That changes the landscape for a lot of these industries.
No, I totally agree with you. And I think that something needs to change for LPs that want to continue to invest in venture funds. If they are not, getting capital back, then they can't continue putting capital to work in these funds. And I think from the employee perspective too, if the employees aren't, being able to get liquidity from their equity, they're not going to go want to, work at these startups until they're at a certain scale where they know there's real value there. And I think you can already see that today, where a lot of talent don't want to go work at seed stage companies.
No, that's true.
And it's extremely challenging to recruit high quality people at seed, even if you had Sequoia.
Not even seed, A or B.
Yeah, or A and B.
C is like where people start like this talent starts feeling. I have a ton of friends who are in big tech and they start feeling like the comp is somewhat like if they're going to be the 100th hire in the company, they're trying to de-risk their future.
Yeah.
Right. And that's only companies that have a product in the market that's working, that's functional, that have revenue.
The seed stage, seed and series A, they have to go after the broken resume.
Yeah.
Or people that they have like a strong connection to, that they went to college with, worked with at their last job.
Networks end up being important.
Very important.
That's where.
But you're not going to recruit some top talent that's making millions of dollars a year at one of these hyperscalers.
Speaking of tokenizing IPOs and Robinhood and Coinbase, you were a seed investor in Robinhood.
Yeah, super lucky.
Tell me more about that story.
So we actually got the introduction from Chad's brother, Blake. He was friends with the founders from Stanford. And at the time, they had not launched their product yet. I remember the meeting specifically because we did it at the Rosewood Hotel on Sand Hill.
Classic.
And we went and met with them, and they kind of told us their vision of fee-free trading and how they worked in high frequency trading in the past. And I think we just like jived with them really well. We were super ecstatic about like the possibility of what they wanted to build. We had absolutely no clue it was going to get as big as it did. I remember they had a bunch of institutional investors that invested in that first round, and they needed to go out and get their broker dealer license. And we were the only investor that was willing to kind of open up our books and be like the investor of record for FINRA. So we had to do all this work to make sure that they could get their broker dealer license, which was not that hard, and they got it. And kind of the rest is history. I mean, I think they got a massive wait list for when they originally launched, and we were super impressed by how many people they got on their wait list. And then they were able to convert a huge number of those individuals to start using the product. I think my realization on it, I could be totally wrong, and they would probably say I was wrong about this.
Yeah.
But my feeling on why they were so successful is really intuitive UI. And it was just a great user experience. And it took away all the friction from investing. I personally don't think that it was that big of a deal that it was fee-free. I could be totally wrong on that, and they probably say that. My feeling is that they fronted people money so they could start trading right away. And it was just easy, guilt-free. You felt like you could, make decisions quickly. And it wasn't like a bunch of different things that would scare you about investing.
Referral budget.
Yeah. And so I think that was the big reason that they succeeded and are still succeeding today. I mean, today it's a lot of different reasons, all the different products that they built. But I think back then that was what I got super excited about. It was just so easy to use.
Well, hopefully you didn't sell too early. They've become a massive company. Since they've 100x since IPO? 10x since IPO?
Yeah. So everybody calls me crazy, but I kept 80% of my stock. So I still own a lot of Robinhood stock. A lot of Robinhood stock.
Nice. Yeah, I mean, I'm sure everybody was probably, when Robinhood shares went down to, under 10 or something, right? Like at some point, everybody was probably telling you were crazy or something.
Crazy.
Right?
Crazy.
So what was the thought process at the time to hold on to the shares? Did you think just the company was massively undervalued? The market didn't price in everything?
My feeling is like, it's very easy to see all the different products that Robinhood needs to build. And every single time that Robinhood launches a new product, they increase engagement with their current customer base, but they also attract new customers. And this is an AUM game. And so the more AUM that you gather, the bigger business is going to be.
Right.
And they are offering kind of a super app like no other financial platform is doing. Obviously, they have crypto, they have prediction markets, they have public market equity trading, they have options. They're coming out with a private bank, hopefully sometime soon. They have their tokenization project in the EU only, not in the United States. And so I feel like as there's this generational shift and all of this next generation starts inheriting money from the baby boomer generation, they're going to want to put their money somewhere, and it might not be where their parents put their money. And my bet is it's good as Robinhood's going to be able to capture a lot of that market share. And I think it's kind of going to be the Netflix of finance. And I feel like it's going to be a massive business from here. And there's still a long way to grow. And the numbers are just going to get bigger and bigger. And so I'm a long-term holder of Robinhood. And I think that Vlad's been, an amazing leader, a product visionary, and has just done a tremendous job at building this business.
We talked about like the founder journey from seed to scale, and how you have to evolve as an executive, as a founder, to take that product and build it into a really scalable business. So what evolution have you observed in their journey?
Well, I was never on the board of Robinhood, and so I don't know all the ins and outs that have occurred, but from like an outside spectator, my feeling is that at a point in time, there's all these different things that the company could build. Is like, here's one shiny object and here's another shiny object. And they'd start going down one direction, but then they'd find another shiny object, a product that they want to release, and they'd stop working on this other product. And they just weren't releasing, the features that they needed to be. And they realized that they needed to focus or build the resources to be able to develop multiple products at the same time. And so I think there was a period of time that it was just challenging to push products out the door, and that you only have so much bandwidth, you only have so much resources. And at that stage, you just need to get things done.
I guess
and some products are going to be successful and, some are not. Right. And you just have to be okay with that.
I guess focus is like the answer I'm hearing there. It was focusing on the right things and not.
I think prioritizing for them, prioritizing the right products at the right time. And not trying to do everything all at once.
Speaking of Robinhood and their founders, one of the co-founders is building in the physical world. Which your thesis, Baiju. Right. Etherflux is that the company?
Very cool. I'm not an investor in it, but I think it's like super compelling business. It makes a lot of sense. He pivoted into that. It was originally he was trying to create solar through satellites and then beam it down to Earth.
I see.
And now he's doing data centers in space, which make a lot of sense. And I think this like business makes a lot more sense to me than the solar in space. But I think the solar in space could have worked too. It just would have been extremely expensive. But this makes a lot more sense.
It's that wave analogy. It's that wave analogy. At this point in time.
The timing seems right. Maybe. Hopefully.
What might make more sense?
Hopefully.
That's interesting. What is something you've changed your mind on over the last year or so? Like you've gone 180 on?
Oh man, there's so many things. I don't know if I'm right on any of them. But there is a company that we looked at that was in kind of the AI like text to video space that was like growing, that had some momentum. but we felt like it was a super competitive landscape and that was very challenging to see who was going to win.
Mm.
And they have continued to grow and now are doing hundreds of millions in revenue.
Mm.
And I felt like, okay, we probably should have done that deal. That was a mistake because they've hit like terminal velocity. It seems like there's a lot of, people that love that product.
Mm.
And so, really understanding like customer sentiment is super important. And maybe we just didn't go deep enough to understand like what was happening at that time.
What was the company?
I'm going to share the company now because maybe we still have a chance of getting in, but,
what else? You said quite a few things you changed your mind on.
Oh, so many things. I can go back so many years on so many mistakes that I've made of not investing in certain things. I think when I first I remember a friend of mine had invested in Uber and it was at a very early stage. They were raising like a Series A and he did the seed and he's like, hey, do you want to buy some of my shares? It's a $60 million valuation.
Yeah.
And my answer should have been, yes, I definitely want to buy some of your shares. Whether or not he would have been able to get that approved, probably not. But at the time I was like, it's only in San Francisco. They're only using black cars.
Yeah.
They didn't have like the Uber X or anything. They didn't have like the app worked, but it didn't like work perfectly yet. And I was like, how big of a market can this be? Black cars in every city. That was like a huge miss, obviously. What I was thinking at the time, like I have no clue, but I still like bang my head against the wall on that one of like, I should have tried. And then we saw Anthropic at I think it was like a $6.1 billion valuation. They were doing 5 million in revenue, but projected to do 50 million in revenue that year. And we were like, wow, that seems like a crazy valuation for a company that's only doing 5 million in revenue to be valued at 6.1. And are they even going to make it to $50 million? Well, obviously I was incredibly wrong and we should have definitely invested at that level. So I think like understanding what potential outcomes can be is like absolutely critical to being a great investor. And so I don't think it's necessarily like the entry point valuation that you want to be looking at. I think it's what's the outcome from here?
Right.
And can it grow past? I mean, it was growing like 10x year over year, probably end up growing like way faster than that. But that was kind of the projections at the time.
Would you say you're more outcome oriented now?
Definitely more outcome oriented. Definitely more outcome oriented.
So what has that, having missed out on those opportunities, how has that rewired your brain? Or what has that rewired in how you think about future opportunities?
Yeah. So growing up, I was a competitive skier. And I remember, I would have mistakes in my run. And at the bottom, I'd be like, I just want a time machine and go back and try and fix those mistakes. And so what I started doing is before the run, I'd say, okay, this is my time machine. I can make sure that I don't make mistakes now before my run takes place. And if I do, I'm okay with those mistakes because I deliberately am trying to do my best job that I can and finish the run like mistake free. And so when I look at companies today, I try and use that same mentality of I need to make the decision now whether we're going to invest or not going to invest. And I have to live with my mistakes if I make them and not use revisionist history to say what would have happened if I invested, and do the work ahead of time and take the mental approach that this is my time to shine. I have to make the best decision here and now.
Outside of that, what observations, thoughts did you hold, beliefs did you hold about the industry, the ecosystem, maybe a decade ago that have changed over the last few years?
Yeah, I think we talked a little bit about this in breakfast, but not on the microphone, which is, I think when I first started out, there weren't that many software companies actually compared to today. And if a company had a real solution, businesses would seek it out to use it. And it would be like a pretty big lift in their business once they did the training. And it was a much easier sales cycle. What's happened today is that it's a lot easier to start these companies. There's a lot more enterprise SaaS businesses out there, a lot of wrappers on top of the AI horizontal models that are all doing similar things. And it's very challenging for these customers to be able to tell which is significantly better than the other. And most of the time, they're not significantly better. They might be 5% better or 10% worse, but they're kind of all in the same bound. And I think when I first started investing, you didn't have as much competition as you do today. And because of that, the stakeholders that are making these buying decisions at these businesses have a really hard time cutting through the noise and understanding what products they should buy, or if they should just use these larger businesses bundled services at a much cheaper price. And so to cut through all that noise, go to market has just become so much more challenging, and the go to market motion needs to be so more highly refined that, I think back in the day, you could have like an okay, go to market motion and still succeed because you get a lot of organic growth or word of mouth or people love the product, et cetera.
Right.
And now your go to market motion just has to be exceptional to win. And a lot of founders, they don't put the resources or the time into go to market at the early stages. And if you think about your product and engineering team, if you have the resources, if you're a super small company, it's totally different. But if you have the resources, your go to market team should be equal to your product and engineering team. And I would say most of the companies that I look at are not resourced or don't have the right people in go to market. And so they're not figuring out that motion, but you have to be best in class to win.
I guess it's because of the level of competition, you just need this like super, I guess, premium treatment as like enterprises, as bigger businesses, right? Like the relationship management looks different. The business development process looks different. And so the founder cannot like just continue scaling that as a founder-led sales motion for longer periods.
Yeah. I think founders that are using founder-led sales, they're great at the beginning to validate your product and to see that there's a customer that is willing to purchase it.
Right.
But then it's a different skill set of building out a go-to-market motion. And a lot of founder-led sales they're selling into their friends or their own network.
Yeah.
And it's totally different, like building out a pipeline and figuring out how to get in front of potential customers using other channels. And so building channels is super challenging, whether it's like, inbound through marketing, or if it's like outbound through a direct sales team or a PLG motion. I think, you have to figure out what works best for your business. The advice that I can give to founders is build a world-class team around whatever channel you want to focus on and find people that have done this before and been successful. Otherwise, you're just going to be spinning wheels trying a lot of the same things that people have already tried,
right,
that you don't need to be trialing and spending money on.
Right. Well, you're a founder, not of a company, but of a venture fund. And what you have to do is, go out and fundraise as well, as founders have to do.
Yeah.
What have you learned, or when you started out, you didn't have background in fundraising, right? Like you started from scratch. What have you learned about fundraising over the years?
I mean, I think fundraising is hard for everybody.
Yeah.
I think that, I think it's building a layer of trust where people trust that you're a good investor and you're going to do right by their money. I think I would like to get my investors more liquidity. It's frustrating not having the liquidity that, we would have liked to have when we first started investing. But I think it's all about building relationships. And so giving the LPs access to the founders as well and getting them to meet them, understand the businesses, the trajectory of those businesses, what they're investing in. But I think a lot of it is just, about trust, that we're going to invest them into great founders and great companies, and that we're going to work super hard to help build those businesses over the long term and get some liquidity for them and a strong return. Because at the end of the day, LPs have options. They can invest in lots of different sectors, and they can invest in the public markets that have instant liquidity, or they can invest in illiquid investments like in venture. And, for them to want to invest in venture, they have to get a higher return than the market because of the illiquidity premium of not having access to their capital for long periods of time.
But the thing about trust is it's hard to scale.
Yeah, I think that's where, like, the Andreessen Horowitzes of the world, or the big like asset gatherers, have really built phenomenal brands. And it's the type of thing where LPs, aren't going to get fired if they invest in one of those platforms,
right?
Because so many other LPs are investing in them. I think from an LP perspective, if you take more risk, just like, an investor is taking more risk, and you invest in, some of these smaller managers, you have, a chance of like a bigger return, And I think for us, what I always tell LPs is, our goal is to get you a 5x net return on your capital, if not better. Cause that's kind of like the benchmark. Is the market's probably not going to do that well over the same period of time. So if we can get you that sort of multiple, it was worth it for you to invest in our funds.
I want you to go back to raising that first fund when you're selling an idea, right? And you don't have the track record. You have the angel investing track record for sure, but besides that, you don't really have the track record. And it's one of the few seed funds around at the time, right? Like it's you could probably count how many like well-known seed funds there were, right? So how do you get the buy-in for sort of still a novel idea at the time, and it's the first fund? How do you get people to back you?
It was a long time ago, so I got to remember exactly what I said. But one thing is, we had to go to a lot of individuals and family offices. That was the majority of our LP construction. And I think a lot of people didn't know if they're going to make money or lose money.
Yeah.
And I would make jokes afterwards like, wow, we ended up being a phenomenal investment for you, because we, absolutely crushed it for our LPs in that first fund by investing in Robinhood, and everybody did extremely well. And we're very enthusiastic that they invested in that fund.
Yeah.
But I think the truth is, we didn't know if we were going to be successful or not. It was like very early days. And I think that the big thing that we pitched was access to great deal flow. It's going to be a small fund, and we just need to hit one deal for this to be a great return for you. And I think, the people that we were able to convince, obviously profited and did really well from that investment. And I think it was like right time, right place, and timing's everything. Timing's everything. And it just happened to be a very good year in venture. And I do think if you look at the different vintages in venture, there's a lot of vintages where a lot of the funds performed well. And then there's a lot of vintages where a lot of the funds didn't perform well. I don't think that 2021, 22 vintage is going to be a great vintage. And so I think we could have hit lots of different winners in 2012, 2013. And if it wasn't Robinhood, maybe it was something else.
Right.
So
maybe it was Pinterest or some.
There's so many different companies that we could have hit.
Right.
That I think if you look at a lot of the seed funds during that time, many performed exceptionally well.
So yeah, I guess the idea of selling yourself is more important, and the idea. And then of course, like on top of that, if you're able to execute, then that just compounds over time in interesting ways. This timing thing, I'll have to come back to it. We'll have to do We'll have to do a master sort of class, mini master class on what being right on timing means.
Yeah. I'll take it too with you.
But we'll wrap up, and I usually like to ask some personal questions around, favorite movies, favorite TV shows. So what are your all-time top 3 favorite movies of all time?
Ooh, that's a good question. I really like The Usual Suspects. Kaiser Sose. I don't know if you ever watched that movie.
No. Ali mentioned that as well. Right? Yeah.
I mean, it's a classic. Everybody likes it. I like Shawshank Redemption a lot. Great film. I like Wall Street just because of greed. I think it's about investing, and I don't know if it's the right type of greed, but I think the original Wall Street was like an interesting movie, and I think drove a lot of people into finance. And I think the same thing's true with The Social Network to startups. So I think movies do like influence culture, probably more so back in the day than they do today. But those are some classics. As far as TV shows, I mean, there's so many good TV shows now. It's like, how do you choose? But yeah, I think obviously I loved Game of Thrones when it was on. I like Friends back in the day. And classic. That was like a classic. And same with Seinfeld. I mean, I watched a lot of Seinfeld and Friends growing up. So there's kind of like both the old school ones. Yeah. But newer stuff that I'm watching, man, I mean, there's so many good shows. I don't know how to choose.
What is a show you watched recently that you were really impressed by?
I just started watching The Night Manager, which is good. I like that show. But yeah, there's so many. I mean, that's just this week.
Favorite books of all time, or one you've read recently?
Yeah, I think I'll talk about some old school books. There was a book called The New Thing. I don't know if you guys ever read this book.
No,
but you should.
What's it about?
It's about Netscape.
Oh,
and the reason why Netscape went public and kind of the history behind it, and it kind of talks about one of the main investors in Netscape really wanted a new boat, and he wanted the company to go public so he could get this new boat. And then when Netscape went public with very little, profits or revenue, it created this whole internet boom in the mid 1990s where all these other companies started going public without any real revenue or profits. And it was one of the first companies to kind of spearhead the IPO movement during that time, and might have created the IPO bust as well, in the late 90s, early 2000s.
Oh wow!
So it's a good book to read. And then I read a bunch of old Hollywood books too. I mean, I think Mark Andreessen probably read these for his fun. But The Operator, about Michael Ovitz. The Keys to the Kingdom. I think The Last King of Hollywood, about Lou Wasserman and how he built his empire. He originally ran a talent agency, and then bought Universal Studios. I think how he built that is super interesting. And then there's a classic book about energy and oil called The Prize, which is really good. I'm trying to stay away from all the tech books that everybody's
these are great
recently. But I do like the tech books as well. John Doerr has a great book called Measure What Matters, which is about OKRs. It's really short, sweet, easy to read. That's a great book. Obviously, the Steve Jobs book, I love. The Elon Musk book,
I love. Biographies?
Yeah, the biographies.
Walter Isaacson?
Walter Isaacson. He used to be the head of the Aspen Institute, by the way.
Oh, interesting.
But yeah, I love all the tech biographies as well. Those are great books, and kind of read them all.
What's your favorite food cuisine?
I like Japanese food and Italian food, sushi and pasta.
So you're well served in Aspen.
Yeah, well served. Yeah.
And what's your favorite kind of drink?
I've been on this health kick, so I don't drink that much alcohol anymore.
Okay.
So it's mostly like water and electrolytes is what I drink.
Okay.
Or sparkling water, flavored sparkling water.
Are you off of caffeine too?
No caffeine, no alcohol.
Oh, wow.
So
Just get enough sleep in the night.
Yeah, just focus on sleep.
Exercise. Yeah.
Yeah. We invested in Whoop, and so it tracks your sleep, and
okay.
Want to make sure whenever I drink alcohol, it's like my sleep is just horrible. So want to make sure I sleep well. So I'm focused for my podcast.
No, this is awesome. Seth, thank you so much for having us over in Aspen. This was a blast. Hope to come back on some of our predictions. And I don't know if we'll do a poly market. but yeah, thanks so much for coming on.